Before we get into the numbers that are currently shaking up Wall Street, I want to give a shout out to Malcolm Young in the comments. He mentioned that I should remind everyone to hit the like button because some of us are dealing with ADHD and just plain forget the small stuff. I hear you, brother. This channel has never been about begging for likes or playing games with the algorithm. It's about traders and investors breaking down the market for other traders and investors. When you drop a comment or a like, it's just a way for me to see that the squad is tuned in and that I'm not just talking to a wall. Also, for everyone asking about the Economic Ninja episode, it is coming very soon. My team and I have put a lot of hours into it, and I think it's going to be the final word on that situation. Now, let's talk about a forecast that just hit my desk. I had to read it 3 times to make sure I wasn't seeing things. Bank of America just raised their gold price target to $6,000 per ounce by mid 2026. Just a few weeks ago, most of the big banks were clustering around $5,000. Moving that target to $6,000 is a massive shift in sentiment. As we talk today, in late January 2026, gold is sitting around $4,550 and silver is at 103.93. The gold to silver ratio is near 48 to 1. That is the tightest we have seen it since 2013. If gold actually hits $6,000 and that ratio stays even remotely close to where it is now, we are looking at silver prices that most people still think are impossible. Why the goalposts moved. The Bank of America report, led by the head of metals research Michael Widmer, isn't just throwing out a big number for headlines. They are basing this on what they call unorthodox U.S. fiscal policy. In plain English, that means the United States is running massive budget deficits and our debt to GDP ratio is at record highs. When the government has to print money to cover its bills, the value of that money goes down. Gold has always been the primary hedge against this kind of currency debasement, and we are watching that play out in real time. It's not just Bank of America either. Ed Yardeni is calling for $6,000 by the end of the year. JP Morgan is looking at an average of 5,500 for late 2020. What matters here is the clustering. When all the major institutions move their targets from the $2,000 range to the $5,000 or $6,000 range in just 2 years, you know the structural reality of the market has changed. The central bank factor. One of the biggest drivers here is that central banks have stopped being occasional buyers and have become consistent accumulators. In 2024 and 2025, we saw record-breaking purchases from the official sector. In many countries, gold reserves have now actually surpassed their holdings of US Treasuries. Even with all that buying, the average gold allocation for these banks is only about 15% of their total reserves. Bank of America's models suggest that a truly optimized reserve would be closer to 30% gold. This means the buying could continue for years. This isn't a temporary trend, it's a structural shift. Sovereign nations are diversifying away from the dollar, especially after seeing what happened to Russia's reserves in 2022. When central banks buy, they don't sell into rallies like retail traders do. They hold for the long term. The institutional underallocation. The second big driver is that professional investors, big funds, and high net worth individuals are still barely holding any gold. Right now, most professional portfolios have about 0.5% allocated to gold. That is incredibly low. Bank of America pointed out that even a tiny increase in that allocation, maybe moving it up by just 1 or 2%, would create a demand surge that would easily push gold past $5,000. If institutional money starts moving toward a 5 or 10% allocation, the price impact would be massive. On the supply side, things aren't looking much better for the bears. Major North American gold miners are expecting production to drop by about 2% this year while their costs are rising. Miners can't just flip a switch and create more gold. even at $5,000 an ounce. It takes years to bring new projects online, and energy costs are eating into their margins. The silver math now. Let's look at what this means for silver. This is where the math starts to get really interesting. Bank of America notes that silver's upside potential actually exceeds gold's. Their report suggests an average of $60 for the year, but we're already at $103. That shows you how fast the market is outrunning the analysts. Let's look at the gold to silver ratio. Historically, it's hovered between 50 and 80, but in times when supply was tight and demand was high, it has traded closer to 30 or 35. Right now, we are in a structural deficit. We've had 5 consecutive years where the world used more silver than it produced. In 2025, that shortfall was somewhere between 95 and 117 million ounces. We are looking at a total demand of about 1.24 billion ounces against a supply of only 1.12 billion. Here is the straightforward math. If gold hits $6,000 and the ratio stays at 50 to 1, silver is at $120. If the ratio compresses to 40 to 1, which is a very normal historical level, silver hits $150. If we go back to that 33 to 1 range we've seen in previous bull markets, you are looking at silver between $170 and $180 per ounce. This isn't hype or a random guess. It is simple arithmetic applied to a market that is fundamentally broken. When gold rallies this hard and silver is in a supply deficit, the ratio almost always compresses. This is why analysts like Mike Maloney believe silver could outperform gold by 6 times or more in the coming years. The industrial hunger. The reason silver's deficit is so much more real than gold's is because silver actually gets used up. Gold mostly sits in vaults. Silver goes into solar panels, electric vehicles, and AI data centers. Solar panels alone now use about 20 grams of silver per unit. Electric vehicles can use up to 2 ounces of silver for their wiring and sensors. By 2030, the International Energy Agency thinks solar and EVs alone will take up half of the world's silver production. That leaves almost nothing for jewelry, coins, or bars. And unlike copper, you can't just swap silver out for something cheaper. Its conductivity is unique. If you want the tech to work, you need the silver. By 2050, we might have used up nearly all of our known silver reserves just on solar power alone. This is part 2 of our deep dive into the massive shifts in the precious metals market. In part 1, we broke down why Bank of America moved the goalposts with their $6,000 gold forecast and how the basic math points to a silver price that most people haven't even considered. Now, let's look at the actual catalysts on the ground, the supply shock out of China, and the physical scramble that is currently breaking the paper trading system. To understand why the silver market is moving so violently right now, you have to look beyond the charts and at the physical reality. In 2025, the total silver demand reached roughly 1.24 billion ounces. At the same time, total supply, including everything from mines and recycling, only came in at about 1.01 billion ounces. That leaves a deficit of over 230 million ounces. To put that in perspective, that is the equivalent of the entire annual output of Mexico, which is the world's largest silver producer. This isn't a one-off event either. We have been running a structural deficit for 5 consecutive years now. The industrial hunger. Unlike gold, which is mostly stored in vaults, silver is being consumed at a record pace. Between 50 and 60% of all silver used every year goes into the tech and manufacturing sectors. We're talking about solar panels, electric vehicles, and semiconductors. The International Energy Agency projects that by 2030, the solar and EV sectors alone will gobble up half of the global silver output. That leaves almost nothing left over for the things we usually think of, like jewelry, coins, and investment bars. By 2050, the demand from the solar industry alone could potentially equal nearly 100% of today's known silver reserves. Because silver is used in such tiny amounts across millions of different products, it is very difficult to recycle efficiently. Once it's used in a circuit board or a solar cell, it is effectively gone. The January 1st bombshell. While this long-term demand was building, a massive geopolitical shift occurred just a few weeks ago. On January 1st, 2026, China officially implemented new export restrictions on refined silver. Under this new policy, only large, state-approved companies are allowed to export the metal, and only after they secure special government licenses. To even apply for a license, a firm must show an annual production capacity of at least 80 tons. This effectively cuts out hundreds of smaller and mid-sized exporters that the rest of the world has relied on for years. China currently controls between 60 and 70% of the world's refined silver supply. By tightening these screws, they have created an immediate global supply shock. This looks very similar to the strategy they used with rare earth metals, where they used export controls to secure their own domestic industry while gaining global pricing power. The lease rate warning sign. We are already seeing the impact of this in the physical market. Since the start of the year, silver inventories in major storage hubs like London and Zurich have come under extreme pressure. One of the most telling signs is the lease rate. Recently, silver lease rates spiked to over 8% on a one-month term. In a normal market, that number is much lower. When lease rates jump like that, it means there is a desperate scramble for physical metal. Industrial users who need silver to keep their factories running can't afford to wait for a futures contract to settle in a few months. They need the metal now, and they are willing to pay a massive premium to get it. We are hearing reports of industrial users signing multi-year supply contracts at prices 20% above the current spot price. They wouldn't do that unless they were genuinely worried about future availability. Staying grounded, the bearish case. Even with all this bullish momentum, we have to look at the risks. No market moves in a straight line forever. The Fed. If the Federal Reserve decides to stay hawkish and keeps interest rates high, that is usually a headwind for silver and gold. Higher rates make bonds more attractive and can put a lid on precious metals. Recession. If the global economy slows down significantly, industrial demand for silver could take a hit. We saw a slight 2% dip in industrial fabrication last year due to economic uncertainty. Substitution. If silver gets too expensive, companies will try to find cheaper alternatives. However, silver's unique electrical conductivity makes this almost impossible in many high-tech applications. Mining supply. Higher prices eventually incentivize more mining. But as we've discussed, it takes years to bring a new mine online. You can't just fix a 5-year deficit overnight. Breaking all-time records. Despite those risks, the market is sending a clear message. On January 23, 2026, silver hit an all-time nominal high of $103.45. We are now well above the previous peaks from 1980 and 2011. What is different this time is that the rally is being driven by a structural physical shortage rather than just paper speculation. We have had 5 years of deficits, declining stocks in vaults, and now export restrictions from the world's largest refiner. When you combine that with a gold market that is pushing towards $6,000, the bearish factors start to look like small speed bumps rather than roadblocks. The path forward. So, what does the math tell us for the rest of 2026? If gold reaches $6,000 by this spring, as some analysts suggest, and the gold to silver ratio stays at 50 to 1, silver is headed for $120. If the ratio compresses to 40 to 1, which has happened in every major metals rally in history, we are looking at $150 silver. If we see a move toward the historical norm of 34 to 1, silver could hit $175 or higher. These aren't just random guesses. They are the result of basic arithmetic applied to a market that is running out of physical metal. The bottom line: this isn't just about a price rally. It is a fundamental repricing of physical scarcity. For decades, the price was set by paper contracts on exchanges that were rarely settled in actual metal. But when inventories drain and lease rates spike, the physical market takes over. Whether you are holding physical bars, trading futures, or looking at mining stocks, the landscape has changed. The paper game is failing, and the era of the physical metal has arrived. If Bank of America is right about $6,000 gold, the silver story is just getting started.